Have you ever wondered why the stock market crashes seemingly out of nowhere? It's like watching a bustling marketplace suddenly turn silent, with vendors packing up and customers rushing for the exits. But what exactly causes this chaotic shift? At the heart of a stock market crash is something called a loss of confidence. Imagine if you were in a crowded restaurant and one person suddenly shouts that the food is contaminated. Instantly, everyone panics, drops their forks, and bolts for the door. In the stock market, this panic can stem from various triggers: a bad earnings report, geopolitical tensions, or sudden economic shifts. When investors fear that companies won't perform as expected, they rush to sell their shares. But there's more to it. Let's dig into how the mechanics of selling amplify this situation. Picture a game of musical chairs. As the music plays, everyone is calm and sitting pretty. But once the music stops, like when bad news hits, the scramble to find a chair, or in this case, a buyer, becomes frantic. This is known as market liquidity. When everyone decides to sell at once, the number of buyers can't keep up, leading to a rapid drop in prices. And here's the surprising part. Often, these crashes aren't just about the immediate news. They can be fueled by fear and speculation, like a wildfire spreading through dry brush. The psychological aspect is critical. Investors start to anticipate further declines, leading to even more selling. So in essence, a stock market crash is a complex interplay of lost confidence, panic selling, and psychological dynamics. Understanding this can help demystify those surprising market downturns. If you find this intriguing, stay tuned as we explore more about the factors that can lead to these dramatic shifts. How are stock prices actually determined? At its core, it's all about supply and demand, much like your local farmer's market. Imagine it's a sunny Saturday morning, and farmers are selling fresh strawberries. If there are only a few baskets available and everyone wants them, the price goes up. But if every farmer has piles of strawberries and hardly anyone shows up, the price will drop. Now transfer that idea to the stock market. A company's stock price reflects how much buyers are willing to pay versus how much sellers want for their shares. When more people want to buy a stock than sell it, demand outstrips supply. That drives the price up. Conversely, if there are more sellers than buyers, the price falls. Here's the surprising part. This isn't just about how a company is performing on paper. Emotional factors, news, and even market trends come into play. For instance, if a company announces a new product that consumers love, excitement can spark a rush of buyers eager to invest, pushing the price higher. On the flip side, bad news like a scandal or poor earnings can send investors scrambling to sell, causing prices to plummet. This dynamic of supply and demand creates the daily fluctuations in stock prices. It's a dance of psychology and economics, where fear and greed often lead the way. Understanding this fundamental principle of stock pricing lays the groundwork for grasping why crashes occur. So when we talk about a stock market crash, remember, it's often an extreme shift in this balance of supply and demand, triggered by a variety of factors. Stick around as we explore this further in the next scene. Why does the stock market sometimes feel like a roller coaster ride? The answer lies in something you might not expect: investor sentiment. It's not just numbers and charts. Human emotions play a huge role in how prices move. Imagine you're at a concert, and the band starts playing your favorite song. The crowd erupts in cheers, everyone is singing along, and that energy is infectious. Now picture the opposite. The band suddenly stops, and the crowd goes silent. That shift from excitement to anxiety can happen in financial markets too, and it can happen fast. When investors are feeling optimistic, like when a company announces great earnings, there's a collective euphoria. People rush to buy shares, pushing prices higher. This can create a feedback loop. Rising prices make more people want to jump in, thinking they'll miss out on a great opportunity. It's like everyone at the concert wants to dance when the music is pumping. But here's the surprising part. When things turn sour, that same group can become anxious or even panicked. If a major economic report comes out worse than expected, investor sentiment can flip. Suddenly, everyone wants to sell, fearing losses. Prices tumble as people rush to exit their positions, creating a downward spiral. The energy shifts from excitement to dread, and it happens in mere moments. Understanding this emotional component is crucial. It's not just about the fundamentals of a company or market. It's about how investors feel in the moment. By grasping the influence of sentiment, you can better comprehend why markets don't always reflect reality, because they're often driven by human psychology. So, investor sentiment can swing wildly, causing panic or euphoria, which drives prices up or down. And that's why keeping an eye on the mood of the market can be just as important as looking at the numbers. What if I told you that the stock market is like a big, complex machine with many gears? Investor sentiment might be one gear, but there are other crucial ones that can either keep it running smoothly or cause it to grind to a halt. Let's talk about external factors like economic indicators, unemployment rates, inflation, and interest rates. Imagine the economy as a living organism. When unemployment rates are high, it's like the organism is sick. Fewer people have jobs, which means less disposable income. People are spending less, and businesses see reduced sales. As a result, investors start to worry about future profits, pushing stock prices down. Conversely, low unemployment typically signals a healthy economy, which can boost stock prices because companies are thriving. Now, consider inflation, which is essentially the rate at which prices for goods and services rise. Picture it like a balloon. As more air money is pumped in, the balloon expands. But if it expands too quickly, it risks popping. When inflation rises too high, it can erode purchasing power, leading to less spending. Investors fear that companies might struggle to maintain profits, and down go the stock prices again. And here's the surprising part. Interest rates play a huge role too. When the central bank raises interest rates, borrowing costs go up. Imagine if you had to pay more to fill your car with gas, you'd probably drive less. Similarly, when businesses face higher borrowing costs, they might cut back on expansion or hiring, which can slow economic growth. Investors often take this as a signal to sell, causing the market to drop. So while investor sentiment creates waves in the market, these economic indicators are the tide that can either lift those waves or pull them back down. Understanding these factors helps clarify why the stock market reacts the way it does during turbulent times. What really happens when one stock starts to drop? Picture a row of dominoes standing tall, each one balanced precariously on the next. When the first one tips over, it doesn't just fall silently. It sends shockwaves through the entire line, leading to a cascade of falls. This is essentially how a stock market crash can unfold. Let's say a major company reports disappointing earnings. Investors worried about the future start selling off shares. As that first stock drops, others in the same sector begin to follow suit, reacting to the news. This happens for a couple of reasons. For one, it triggers panic. Investors think if this big player is struggling, what does that mean for others? So they start selling to avoid losses, pushing prices down even further. And here's the surprising part. There's a psychological element at play here. Many investors are influenced by what's known as herd behavior. When they see others selling, they feel compelled to do the same, fearing they'll miss the chance to get out before prices fall even more. This creates a feedback loop. As more stocks drop, more investors panic, leading to even more selling. Now, consider how this can escalate. It's not just individual stocks dropping, entire sectors and indices can start to tumble. As the market falls, those who are leveraged, meaning they borrowed money to invest, face even greater pressure. They may be forced to sell their positions to meet margin calls, contributing to further declines. So the next time you hear about a market crash, remember that it often starts with a single stock, but the ripple effect can create a market-wide avalanche. Understanding this domino effect can help you see how interconnected the market really is. What actually causes a stock market crash? It's not just one thing. It's a mix of psychological and economic factors all swirling together like a storm. Imagine a crowded theater. If someone yells fire, people panic, and a stampede can ensue, regardless of whether there's a real threat. This panic can trigger a market crash, where fear drives investors to sell off stocks en masse, pushing prices down. But here's the surprising part. Psychology isn't the only player in the game. Economic indicators like rising interest rates, poor corporate earnings, or geopolitical tensions can act as catalysts. For instance, when interest rates go up, borrowing becomes more expensive. This can slow down consumer spending and business investment, leading to lower earnings for companies. If investors see these signs, they might decide it's time to exit the market before prices plummet. The interconnectedness of today's markets also plays a role. With the rise of algorithms and automated trading, a single sell-off can trigger a cascade effect, much like a domino falling and knocking over the rest. The more connected the markets are, the faster the sell-off can spread, sometimes with alarming speed. So understanding the factors behind market crashes can help you navigate these turbulent waters more confidently. You can't predict the next downturn, but being informed about what drives these events can empower you to react with clarity rather than panic. If you found this insight helpful and want to dive deeper into the world of markets, you know what to do.